Urgent, see 3 things you can never do with your money. Warren Buffett will tell you everything. Stay until the end to find out everything. But before starting the video, leave your like and subscribe to the channel so you don't miss anything about finance and Warren Buffett. Warren Buffett, one of the richest people on earth, is famous not only for his investment genius but also for his surprisingly frugal lifestyle. Despite having a net worth in the hundreds of billions, Buffett continues to follow simple financial rules that anyone can apply. One of the core principles he lives by, and the first thing he never does with money, is spending more than he earns. It may sound basic, but this mindset is the foundation of Buffett's lifelong financial discipline. Buffett has often emphasized the importance of living below your means, no matter how much money you make. In fact, even when he was a young man making a decent income from his early investments in side businesses, he refused to upgrade his lifestyle dramatically. He didn't fall into the trap of lifestyle inflation, the habit of increasing spending every time income goes up. He still lives in the same modest house in Omaha, Nebraska that he bought in 1958 for $31,500. He doesn't own a fleet of sports cars, and he's known for preferring simple meals like McDonald's breakfasts or Coca-Cola. To him, wealth isn't about showing off, it's about having the freedom and peace of mind that comes with financial independence. This mindset starts with the discipline of spending less than you earn. But why is this so important? Because when you spend more than you make, you trap yourself in a cycle of debt. You become financially fragile. No matter how much you earn, if you're always spending more, you're never building wealth, you're just treading water or worse, sinking. Buffett believes true wealth comes from accumulating assets over time, not from flaunting income. He also warns that borrowing to support a lavish lifestyle is a dangerous habit. Credit card debt, payday loans, and even unnecessary financing can eat away at your ability to invest and grow wealth. Buffett once said, "If you're smart, you're going to make a lot of money without borrowing." He advises young people especially to avoid credit traps and to develop good habits early. Living within your means isn't just about being frugal, it's about creating margin. That margin, the gap between what you earn and what you spend, is where wealth building begins. It's the money you can save, invest, and use to take advantage of opportunities. Buffett often reminds investors that having cash on hand during tough times is a huge advantage. It allows you to act while others panic. This is why he always keeps a significant cash reserve at Berkshire Hathaway. Not because he's afraid, but because he understands the value of financial flexibility. It's the same reason he advises individuals to have emergency funds and not to live paycheck to paycheck, regardless of income level. So, the first thing Warren Buffett never does with money is overspend. He refuses to live above his means or to let lifestyle get in the way of financial security. This simple rule, mastered by a billionaire who could afford anything, might be the clearest lesson in personal finance anyone can learn. Coming up next, the second thing Buffett never does with money, and how it can save you from major investing mistakes. Warren Buffett's second golden rule, and something he never does with money, is investing in something he doesn't fully understand. While this might sound simple, it's a principle that has protected Buffett from massive financial losses throughout his career. It's also one of the key reasons he never jumped on trends like Bitcoin, NFTs, or certain speculative tech stocks. Buffett often talks about the importance of staying within your circle of competence. This concept is central to his strategy. Only invest in businesses or assets that you thoroughly understand, how they make money, what drives their performance, what their risks are, and whether they have long-term durability. When you invest in something you don't understand, you are not really investing, you're gambling. Buffett once said, "Risk comes from not knowing what you're doing." That's why he avoided the dot-com bubble in the late 1990s, even when many others were getting rich quickly on paper. He stuck with companies that had proven business models, strong fundamentals, and long-term growth potential. He applies this principle consistently. Even when highly hyped industries emerge like cryptocurrency or complex derivatives, Buffett remains cautious. He doesn't dismiss innovation, but he refuses to put his capital into something he can't evaluate rationally. This discipline has kept him from many of the market's biggest busts, while still allowing him to profit massively from opportunities he does understand, like Coca-Cola, American Express, and Apple. So what does understanding an investment really mean? For Buffett, it's not just knowing the name of a company or hearing a hot tip. It means knowing how the business earns revenue, what its competitive advantage is, whether it has a sustainable moat, and how it's likely to perform in different economic conditions. If an investment doesn't check these boxes, he won't touch it, no matter how tempting it might look. This rule also applies to trends. Buffett doesn't chase the next big thing just because everyone else is. In fact, he often warns that herd behavior is one of the greatest threats to individual investors. When people invest out of fear of missing out, FOMO, they often overpay, ignore risk, and ultimately lose money when the bubble bursts. Another key piece of Buffett's philosophy is that not investing can sometimes be the smartest move. He's perfectly comfortable letting an opportunity go by if it doesn't fit his criteria. He once joked, "I don't have to swing at every pitch." In other words, patience and discipline are more important than chasing every shiny object in the market. This principle can be incredibly powerful for everyday investors. You don't have to be an expert in everything, just focus on what you do understand. Whether it's a specific industry, a few reliable companies, or simple index funds, the idea is to build your wealth on a foundation of knowledge and confidence, not speculation or hype. In an age where thousands of investing apps, crypto coins, and social media influencers are pitching the next big win, Buffett's message is clear. Never put your money into something you don't truly understand. Coming up next, the third thing Warren Buffett never does with money, and why it's crucial for protecting your wealth over time. The third and final thing Warren Buffett never does with money is panic, especially when markets are falling. While many investors get nervous, emotional, or impulsive during downturns, Buffett remains calm, calculated, and confident. In fact, he often sees bear markets and crashes not as threats, but as rare buying opportunities. Buffett has lived through countless recessions, market crashes, and economic downturns, including the 1970 stagflation crisis, Black Monday in 1987, the dot-com bubble burst, the 2008 financial meltdown, and the COVID-19 crash in 2020. Through them all, his strategy has remained the same. Stay the course, don't sell in fear, and look for undervalued assets. One of his most famous quotes is, "Be fearful when others are greedy and greedy when others are fearful." This mindset is one of the greatest differences between average investors and legendary ones. Most people react emotionally when their portfolio drops. They sell at a loss, try to time the market, or abandon their long-term strategy. But Buffett knows that market declines are not only natural, they are necessary. They create the mispricings that smart investors can take advantage of. Buffett avoids panic because he understands value. He knows that a company's intrinsic worth doesn't change just because the stock price goes down temporarily. If he's confident in the fundamentals of a business, he's willing to hold, or even buy more, while others are running for the exits. That's how he's built massive positions in companies like Apple, Coca-Cola, and Bank of America at bargain prices during turbulent times. In 2008, for example, while the world was in full financial crisis mode, Buffett invested billions into companies like Goldman Sachs and General Electric. These moves were seen as bold and risky at the time, but they ended up paying off handsomely as the economy recovered. Buffett didn't panic. He acted strategically with a long-term vision. He often compares investing to owning a farm. If you own a farm and a neighbor offers to buy it for half its value during a drought, you wouldn't sell it in fear, you'd recognize it as a temporary issue. You'd wait for conditions to improve. Similarly, Buffett views the stock market as a tool for buying pieces of businesses, not just ticker symbols. And businesses have cycles, some good, some bad, but long-term value usually wins. Another key lesson from Buffett is to ignore noise. He doesn't follow day-to-day headlines or try to guess short-term market movements. Instead, he focuses on long-term fundamentals and stays invested through ups and downs. This calm, patient approach has not only brought him enormous wealth, but also peace of mind, something many investors lose when markets get rough. And while many traders try to cut losses, or jump in and out of the market, Buffett plays the long game. He once said, "The stock market is designed to transfer money from the active to the patient." That's a powerful reminder that wealth is built through consistency, discipline, and the ability to stay calm when others are panicking. In conclusion, Warren Buffett never panics in a down market because he's guided by reason, not emotion. He sees volatility as opportunity, not danger. He trusts his process, knows what he owns, and keeps a long-term perspective. For anyone seeking financial success, this is perhaps the most important lesson of all.